There's a song called Feeding the Ducks. I kind of want to click it just to see what that sounds like, but I won't do that to our audience. Okay, we're live. So welcome. We'll go ahead and green screen for a minute while we wait for this to get on all the channels. But first off, I guess we could start with intros. I'm Logan Edmonds, CEO of TTS Cyber. We're a cybersecurity managed service provider. So IT, technology, professional services, cybersecurity, we do it all. And I'm really excited about our guest today we're going to be interviewing. Andy, go ahead and introduce yourself, man.
Yeah, man, I appreciate you having me on. I'm Andy Runyan with UKON. I'm our head of cybersecurity risk services. And what that means is I spend my days working with MSPs, MSSPs, vCISO groups nationwide to help them better understand not just their risk internally, but also their client risk and how all that flows together. So one foot in the insurance world and one foot in the cybersecurity world.
Yeah, and those worlds, that line's increasingly getting more and more blurred.
Yes,
I mean, we're going to be talking about that today, but I would say risk is becoming a much more multifaceted arena in the area of cyber than it ever has been in terms of what needs to be considered. For those of you who are tuning in today as well, I'm turning off notifications because that's going to get old to our audience really quick. But for those who are tuning in, I also will go ahead and post the link in our chat. We do have our big shout out today, our newsletter. We're ready and live for it. If you're interested in doing a 7-minute digest of what the heck is going on in AI, cybersecurity, technology on a weekly basis, because you want to stay up to date, but you don't have the time to spend hours and hours of research, we got you covered. Check out our newsletter, Artificially Informed, links in the comments. Okay, so let's dive in here, Andy, because we've only got 30 minutes today. I'm going to kick off with probably one of the more common questions you get, but I still think it's important. So, what are the most common mistakes that cause businesses to overpay for cyber insurance and become uninsurable? Cyber uninsurable. Yeah, that works too.
Right. No, I mean, the most common thing is ignoring the basics of cybersecurity, right? And I know that sounds kind of like cliche or like, softball, but it's the honest to goodness truth. If you rewind back prior to COVID, if a business, let's say you had a business and you bought your first cyber insurance policy in 2018 and you were a SMB running 10, 20 million in revenue, you probably weren't asked about MFA. You sure weren't asked about MDR, right? You definitely weren't asked about anything regarding encryption or anything like that. Usually in those days, it was like, what's your revenue? What's your address? Have you had a breach? Do you do any crazy, are you in the cannabis industry or adult film or casinos or something like that? That was the whole lab. Well, now today, if you're applying for cyber insurance and you state, they're going to ask you, maybe we don't have MFA everywhere. Maybe we don't have anything sitting on the endpoint. We haven't adopted EDR or MDR. You're going to pay the piper for that. Insurance went through a really, really tough spot post-COVID where they had accepted a lot of poor risk. And I'm not talking about UKON. I'm not talking about any specific carriers. I'm talking about the whole industry, right? Took in a lot of bad risk. They didn't underwrite well, and they paid through the teeth, right? For a couple of years there. 2021, 2022 was really, really bad. So the industry has figured out, I wouldn't say that it's perfect, but we've learned, hey, here are the key questions that make a good risk. Are you backing up? Do you have MFA where it's supposed to be? What's going on the endpoint? Are we patching regularly? What does email filtering look like, right? Are we training our employees? All that fun stuff. And if you ignore that stuff or act like it doesn't apply to you, get ready to be denied or to have a much higher premium and deductible.
I mean, so what I'm hearing is there's quite a few things that can be going on here. Like, this is not a, hey, one silver bullet kind of a deal. There's multiple things to consider, and there's multiple facets that carriers consider when they evaluate, hey, what level of premium is justified for this level of risk.
That's it. And I'll say that, I mean, to date, I mean, MFA and backups are going to make a big deal. Where the change has been over the last couple of years, managed detection and response. There are some really, really interesting studies that have come out in the last couple of years that show that average downtime goes from 15 to 20 days to 2 to 6 days with MDR agents being placed on the endpoint, right? So that's where we've seen insurers kind of shift a little bit, is starting to give good credits or judge risk differently around what's going on at the end.
So that kind of indicates to me, right? It's not so much the initial incident that costs a bunch of money. It's obvious. It's the length, right? The business interruption. That seems to be the multiple carriers. As you talk, that's the recurring theme, right? We want to keep your overall downtime low because I'm assuming business interruption, payouts, all the other stuff. Hey, the shorter we get you back up and running, the more cost efficient it is for the carrier in terms of lost revenues and all and damages, all the other stuff. That's what.
And the better it is for your business. I mean, yada yada. I mean, like everybody's outcome is better if you're down for 2 days instead of 20, right?
Yeah, and that's gonna. I feel like that's gonna be a theme we keep coming back to. Is that insurance really wants to see minimal damages before they come into backstop. And let's keep going. My next question, I think, I'll tie into that. So, right now, you kind of touched into it, but I want you to get a little more tactical with this, right? Let's take an average SMB, and that can range from 10 employees to all the way up to 200.
Right.
If there were only a budget and time to fix 3 things in their org, I would say they have nothing at all. What are the top 3 things from an insurance perspective you think they should be addressing? You touched on some of them, but I want you to repeat and kind of be specific.
Well, I'm gonna throw a wrinkle into this because well, man, only 3. Golly, you really got to narrow it down to 3 because one of the struggles I see is when I go into cyber insurance, right? And customers are like, oh my God, you get that checklist. I don't have any of this stuff. Oh my gosh, it's gonna be so much work to get it done. Change management is real in org, as you know, like you only have so much appetite. So my goal here is, what's the top 3, right? Yeah, I'll give you the main 3 that are going to be most premium impactful, and then we're going to introduce a first cousin that's not going to help with premium, but you need to know about. Let's go that route. So your main 3 are going to be MFA, backups, and MDR, right? Like that's, I mean, hard stop. Like MFA's the big brother, right? Like it's the one where they're asking. Used to it was, do you have it? Yes or no, right? And now the questions are, what vendor are you using? Where's it located? Tell me all the places you've got it within the organization.
Do you have it on all 13 platforms you need to have it on, or do you just have it on the one? Like that, they're asking for nuance now. Yeah,
that's it. Right. We're getting into nuance. So MFA is the big brother, right? The smaller brother and sister are going to be MDR and backups, because if we're used to, it was like, do you back your data up? Well, crap. When we're looking at downtime, if you back your data, if you click check yes, but you're backing up every 2 weeks versus backing up every 6 hours, there's obviously a difference in posture there, right? As far as what's going to have to be recovered and rebuilt. And then MDR, again, we've already hit on this, but like once that data set came out and the Huntresses and the CrowdStrikes of the world, the Black Points of the world really pushed into, hey, folks that don't have this, their downtime, which you're paying for business interruption, Mr. Insurer, right? That's part of the form. Their downtime on average is 2 to 3 weeks. When they have our agents, we're not seeing anybody really, not anybody, but I mean, our average downtime is in the 2 to 4 day range or 4 to 6 day range, right? So I would say those 3. And then the distant cousin, if you allow me a 4th, that's really not premium impactful yet. And I think this is going to change, but as an incident response plan. Right. Okay. And that's not a control. So that's why I'm going to sneak it in as the 4th. Right. But having those 3 controls in place and then developing a solid IRP to go along.
Are you seeing a material difference so when we go into claims, right? Because everyone's asking like, what happens when I actually need to use the insurance? First question about insurance: how much is it going to cost me to maintain it? Second question is, cool, what does it look like when I actually have to use it, and what does it cover? So when you go into claims section, are you seeing a material difference when companies that have an actual IR plan versus those who don't, in terms of the desirable outcome and costs? Like, do you see that?
Oh no, 100%. I mean, it's just like anything else. And I mean, you see the sports stuff. I got my hat on going to watch my son's baseball game today. I'm a coach at heart, right? And if you go back to that coaching background, of course, I'm going to have better outcomes if we practice than if we don't, right? And that's how I look at IRPs, right? Like, if I've got an IR plan and I've run a pen test, and with that pen test, I've done a tabletop exercise, and through that pen test and tabletop exercise, I developed an IRP that we update on an annual basis, right? Or at least an annual basis. And I have an idea of what's going to happen when the stuff hits the fan, then yes, my outcomes are better. And what we're actually seeing on the insurance side, and this is even at the MSP level, right? You've seen this previously, right? And that is,
I'll land, but this is your rodeo. Tell me what you see without my bias, please and thank you.
Yeah, no. I'm just saying, like, I know individually you've seen it, but like you'll see a carrier come in and say, hey, MSP, yes, we'll write your insurance right now, right? You get E&O, you get cyber insurance, but contingent upon us renewing this thing next year at this time, we need you to produce an IR plan, right? So we're seeing carriers start to place that IRP more at the center of the conversation.
Okay. So I'm going to go into a really loaded question. And this one, we're going to pivot here. So I love that. And I do think for my comment on the IR plan is it's a business maturity thing, right? Like, and I think anybody who's been seasoned enough in any business process and leadership knows there's a big difference between operating by the seat of your pants versus if you have a rough outline of a plan that you can reference in times of, of stress, right? Which I would say it's very hard to argue that an incident is not a stressful situation.
Most people describe it as the worst day in the history of their business if you don't think that's stressful.
Okay. So our next question, though, as I was leading to before, and this one is one I know our audience is super interested in. I'm interested, honestly, in your opinion. AI. Everyone's talking about AI, and we're starting to see trickle, especially with this advent of vibe-coded enthusiasm of, hey, how do we put controls around this? How do we manage the risk that this AI, especially as it relates to data risk and operational risk, right? So how is that impacting cyber? Because I'm assuming there's a conversation, at least on your arena.
Oh my goodness. I mean, there's a conversation every day. I mean, we talk about the inherent risk that comes with AI on a daily basis right now. But I'll set the stage with this, right? I'm a history person. If there's anybody listening that's a history person, the way that I look at this is where we're at with AI right now. We are Lewis and Clark. We're in St. Louis and we're looking out west and we're going, man, we think we know what's out there and it's pretty exciting, but we really don't know what's out there, right? That's kind of where we're at with this AI thing. I'll give you a two-part answer on this. Okay. For folks in your arena, for the MSP, for the folks that are offering cybersecurity services, right? They're starting to use AI in a multitude of ways. We see MSPs that are using AI to help with help desk times, to help with filling tickets. We see actual agentic AI, protecting the endpoint and things like that. At the cybersecurity level, at the MSP level, there's questions now around how do I protect myself and how do we audit that AI to make sure that it doesn't mess up, hallucinate, cause some type of issue. And we're not seeing widespread issues with the use of AI at the cybersecurity level, but that conversation is there. How do I ensure against an AI mistake? And how do I audit that AI and build guardrails around it to make sure it's not causing issues for my customers? That's on the cybersecurity side, right? At the client level, where we're seeing the biggest impact with AI is, yes, people that are using it are, the speed of operations and the time that it takes to generate reports or write emails. All that stuff's speeding up. The biggest impact that we're seeing right now is the type of claims that we are seeing coming across our desks, right?
Okay. Talk about
everybody, when the word started, when AI started getting thrown out, everybody was like, holy cow, hackers are going to use AI to make the most badass ransomware we've ever seen, and nobody's going to be able to defend it. That was the fear, right? Knock on wood, that's not really what's happening right now. Right. We haven't seen this massive spike in ransomware claims. They've stayed fairly flat. The severity's gotten a little bit worse, but ransomware claims they've kind of slowly upticked. Nothing crazy. There wasn't this massive spike. Where we have seen a massive spike is on social engineering, invoice manipulation, funds transfer fraud. Because if you think about it, as a society, and this is Andy Runyan's opinion, so take it with a grain of salt, right? What I feel like we got to around COVID, pre-AI, just as a marker in time, we got pretty good at noticing that the Nigerian prince email was BS, right? Like we had seen it. Now it was still getting, you were still getting that older generation, right? Like they were having success with the non-tech savvy folks, but you and I, we would get those emails and we would go delete, like I'm not even going to read it. That's not happening now. We're seeing super tech savvy folks that have grown up with tech fall for invoice manipulation because AI has gotten so dadgum good, right? Like you can jump in, pay for a phishing kit, backed by an LLM. You can generate a phishing email that's in perfect English that talks about your third-party vendors from your website and generates beautiful invoices. And if you're folks that are handling those transactions and that have the keys to the banking kingdom for the company, if they're not trained on how to spot it, what to do if things go wrong, backed by insurance, we're seeing AI drive a ton of social engineering invoice manipulation claims.
I think so. A couple things for this one. I think that it's a matter of scale. So the reason that why would attackers use the Nigerian Prince email scam back in the day, right? Because you're right, we were honest, but you hit the nail on the head. It was a numbers game. You send that out to a couple billion people, you're guaranteed to, even at 0.001%. That's more than what is that? 1 million people right there alone? No, sorry, 10 million people. 10 million people, right? A billion, right? Like right there, like you're going numbers there. What I'm hearing you say is for the social engineering AI, it was impossible to customize that stuff at that scale. You can't customize by hand 1 billion social engineering scams with a human brain. There's not enough hours in the day. AI removed a lot of those barriers. I'm not saying it's 100%, but and I've seen it because I played with AI like everybody else. You can stick an AI bot to scrub someone's social media posts and go through their profiles, figure out where they work. Like that's child's play. It takes about 5 minutes, and then add on another parameter. Hey, write something that they would believe based on their last 3 posts and where they work at, right? Pretend to be something like that. Like I could see that 100% being, even if it does have some hallucination, even if it does have some failure, it's still gonna have a better acceptance rate, I think, than the Nigerian Prince. That's what it comes down to.
That's it. And I mean, just think about, your information. This is the way I try to put it to people. Think about your information. If somebody does gain access to the system, or if they even gain access to somebody else's system, but if they can get a hold of an invoice, if all they can get a hold of is an invoice, right? That looks like an invoice that comes from your company. If AI can put Will Brooks's face on Snoop Dogg's body, yeah, I mean, don't you think it can take that invoice and mock it and change the routing number or the account number on the bank account? I mean, absolutely it can. And people just aren't thinking about that right now. They're using, I use AI on a regular basis to make cartoons to tell my 6-year-old daughter bedtime stories. Well, guess what? The bad guys out there are using it to take your invoices and make them look exactly like your invoices, but they're changing the small details to pull the money into their account.
Okay. We could talk about this for a while, but we're going to need to get moving because we only have so much time, and this one is a whole rabbit hole. So the other risk of AI that we see from a technology perspective, I want to talk about your perspective on the insurance side. So we see specifically operational risk, right? You can absolutely bone your company in the wrong way if you do the wrong kind of governance around your AI. A great example of this is when everyone was playing with OpenClaw. You probably saw all the posts, right? Oh my gosh, we can just make the network or bots do everything. And then after it ran for like a week or two, people started raising their hands and going, it is wrecking the place. What is going on? Right? I watch a YouTube channel called Cold Fusion, and I actually like this guy a lot. He's out of Australia. He does like science and STEM videos. And he's like, let's talk about the rise and fall of OpenClaw. And that was like sort of what happens when AI has no guardrails, right? It's allowed just to go off on its races. We're still not there where it can operate fully autonomously, and at least not in most small orgs. I know I'm going to have my detractors in the comments. But that is my stance. So we're seeing a lot of orgs deploying tools en masse right now. And they're like you said, Wild West, St. Louis, looking out. We're figuring out how we go. They're just throwing, tools like ChatGPT, Claude Enterprise, Copilot in the environment and giving their employees broad access to them, as well as what I've been seeing, not really restricting, especially in these enterprise apps, right? For Microsoft, a great example. You deploy Claude Enterprise, more people now are just saying, give it access to everything, right? Don't restrict what it has access to. It has access to everything. Is this coming into the insurance conversation? Like, is this a thing from a business option? And if so, has the insurance industry started talking about what guardrails they are seeing or they'd like to see in terms of preventing complete catastrophe? Yeah,
no, this is a great question. And again, I'm going to refer back to my Lewis and Clark example, right? The insurance industry is usually about 1 year to 2 years behind on good underwriting. And what I mean is like you and I are having this conversation and you see it as risk. Insurance probably won't start asking questions about AI governance, I would guess, for probably another 6 to 12 months. We're not seeing that heavily right now. Okay. So, and I talk about this regularly in my job. There's what you need to do to get insurance and get a good rate, and there's what you need to do to create good risk. And sometimes the two don't have anything to do with each other, right? So no, is insurance asking what AI you're using as a company, what guardrails around, do you have a man in the middle auditing things as they come in? It's really not asking that right now. Should you be doing that stuff? Hell yes, you should be doing that stuff, right? Like we are going through internally right now, our processes, how do we update with AI? How do we get faster, leaner? And I'll tell you, I listened to Neil deGrasse Tyson last year in Denver. He came to PAX Beyond, and he spoke about the future of AI.
Now I'm sad I missed that one.
Yeah, no, man, it was awesome. It was really cool. So we're sitting there, and John Street asked Neil deGrasse Tyson, like, what businesses are going to succeed? Or is it going to be the ones that ignore AI and don't get burned by the fad? Is it going to be the businesses that jump fully into AI and just go 2 feet in and it's gold rush? They land first. And Neil deGrasse Tyson, I thought it was a really interesting answer, said, no, man, it's going to be the ones that hit the middle, right? Like they learn how to use it as a tool, but they don't fully replace the human. And there has to be this hybrid between, there's got to be a man in the middle. There's got to be that human touch, but we have to learn how to get leaner and meaner.
I think a lot of people underestimate that most businesses are built on 3 or 4 key workflows, right? There's this 3 or 4 things we do every single day, and that's how we make money, right? And so there's less room in a lot of business that I see for let's re-innovate everything all at once. It is more of where the money is at. I'm finding, at least right now at this time, is these individual portions of workflows that have been pain points for decades sometimes, because there's a human, but the human's not efficient. And they implement these very unique solutions using AI and specifically for that workflow, right? And the ones that like are killing it right now are the ones that figured out this is what I want to do. This is the outcome of what I'm looking for. This is how I'm going to make sure it doesn't go off the rails, or if it does, at least the risk of it going off the rails is an acceptable level for me, right? Like I can tolerate a worst case scenario if it comes to pass. Like those are the ones I'm seeing right now that are just making money. Like, there's no other way to say it. They're making money. They're not tinkering. They're not vibe coding a bunch of stuff. They're going in and getting very specific on what they want. And yeah, they're executing quickly. And so let's talk about real quick. I want to come back to a point you made, which is the carriers are usually about a couple of years behind everything. And so the mentality, right, as I understand it, and I want to get your take on this, is carriers usually look at everything like a year in review, right? Like, hey, how did last year go? What's the metrics there? And then they extrapolate to the following year. So that kind of makes sense, right? They're a very, I don't want to say reactive industry, but they work on data that they pull for themselves, and it takes time to pull that data through. And because of that, I think you touched on this, and this is my next question. There are cycles. There's definitely cycles, and cyber insurance has some pretty aggressive cycles compared to the rest of the industry in terms of underwriting and prices. Last year, we saw, I thought, from my perspective, I want to lie with you, like a lot of falling premiums, a lot more competition in the carrier space. Like it felt like it was a good time to get cyber insurance for the first time in 5 years. Where are we at now? Is that cycle still going that direction, or is it going? Are we more closer to 21, 22, where things are tightening down again? Where are we at?
No. Yeah, I would say I'm gonna frustrate probably people with this answer because I'm gonna hedge a little bit. I call it a selectively hard market, and what I mean by that is everybody's like, "Oh, we're in a soft market. We're in a soft market." Listen, if you're under 50 million in revenue and you don't have cyber insurance and you've got phenomenal controls, man, it's a great time to buy it. Like what you said. I mean, we're not seeing. In 2021 and 2022, you could have cyber insurance do nothing wrong and take a 70% rate increase. Like that was happening less than 5 years ago. We have folks that were not writing new cyber business at all during that hard market. Logan, we are so far from that. We're not there right now. There's a ton of capacity. There's
feels like a lot more capital flew in, right? Like that was the big change. Like a lot more capital inserted into the market in terms of where coverage and premiums were. And I get the play, right? Like I do a lot of work with insurance agencies and sell to them. And you literally can't go to a trade show without seeing a pop-up of a cyber carrier, right? Like it's probably one of the fastest growing commercial insurance lines there is right now. No questions asked.
Ton more capacity, a lot softer, but here's the caveat to that and why I say selectively hard. You start getting into manufacturing, healthcare, municipalities, you need more than 1 million, you need 5 million, you need 10 million. It ain't soft, right? Like what we figured out is that the bigger the risk, the larger the loss potential, right? And we're going to absolutely hold those people's feet to the fire from an underwriting standpoint. And if you don't cross your T's and dot your I's, number one, we're not offering a quote. Number two, if we do offer a quote, you're paying a pound of flesh. And we started seeing that, a couple years ago with the hard market as a whole, but that's kind of maintained, right? It's not like it's super easy for a $250 million regional healthcare facility to get cyber insurance right now. if they need $10 million or $15 million.
That lines up what I'm seeing on the implementer side, because what I see from my perspective, and you can nod your head because you're the expert in the room, this lines what you see is like that 1 to 3 million in coverage, right? That seems to be not a whole lot you can do to move the premium number, and not a whole lot of you do the application, I mean, do it honestly, do it fairly, don't lie, don't defraud yourself, but do the best you can, and you're pretty good. The moment you go above that 3 million mark, so 5 million especially and above, like all of a sudden it feels like a proper underwriting process is the best way to say it. Like the carriers are asking questions beyond the application. They're kicking the tires of things. They're asking for I did a 10 million one recently. Holy guacamole. It felt like I was back in doing a third-party government audit again. Like that
supplemental app has entered the chat, right? You had your 20 questions, now you get an extra 30, right?
So that 1 to 3 here in the SMB space, I mean, still do your due diligence, still be careful and make sure you implement controls like we talked about. But as far as an underwriting process, no colonoscopy. Right. Beyond that, your mileage may vary. That's what I'm hearing.
Yeah. And then what's driving that too is for the longest time, everybody just bought $1 million. You know, we had this scenario. It was like, I have $1 million of GL and $1 million of work comp, so I'm going to go get $1 million of cyber. Well, third parties have kind of started figuring this out. And what you're starting to see is, I mean, we've gotten 2 this week, right? Where somebody came in and they're like, hey, I had $1 million insurance. I need to get 5. And we were like, what caused that? Why do you need 5 all of a sudden? You guys have a big kick in revenue? It's like, no, in order to get this contract, we have to have 5 million.
I've seen that too. 100%.
We're starting to see third parties kind of pull that average limit up because people are going, dude, if I'm going to go into business with you, you present a decent amount of risk. I need to know you're insured, right? Similar that they do with GL and everything else, right?
Even the baseline, like it used to be $1 million, like you said, is the baseline. I've come across contracts more and more. Very few of them are asking for $1 million. The baseline seems to be closer to 2 on the SMB. Like it's flat. I'm not going to take any less than 2. It doesn't matter what size company you are. It doesn't matter the amount of business I'm giving you. It's just 2. And I think it's because they realize how expensive incident response is, and there's no meat on the bone for them for their damages if it bleeds over to them if they only have $1 million in coverage. Like it's an economic question. It's not a contractual thing. It's a, hey, if something goes, completely pear-shaped, there needs to be money for us to cover our damages, and you can't just be broke as a joke. We can't get anything out of you for that.
Right. Well, and I mean, the litigious nature of the company and the cost of living is not going down, right? And so, like 5 years ago, you never saw a $5 million demand on a contract. You see them, I'm gonna say all the time, but I mean, I see 5 million once a week, once every couple of weeks.
Let's talk about this because we're segueing right into my next question, right? Like, there's a lot of different kinds of policies you can buy, and we're talking about 1, 3, 5, but there's definitely ones way below that, right? So there is a wide range of policies and premiums and coverages, and I know we kind of touched on that. What are some tried and true benchmarks that a business owner or an executive can use to judge if their policy is strong and not just cheap? Because especially between that 1 to 3, I've seen some great ones for prices that seem very reasonable, and I've seen some terrible ones that are astronomically high in terms of premium costs.
So at the average SMB level for us right now, when we're looking at we'll say 20 million and below in revenue, right? Your average premium's coming in around $5,000, right? So let's just start there. If you are paying in the hundreds and not the thousands, that should be red flag number 1. If you're of any revenue at all, if you're $1 million or more of revenue and you're paying in the hundreds for cyber liability, you've probably got a tack on. So just from a premium standpoint, know that baseline is around $4, $5, $6,000, right? The other piece is from the actual policy itself. It really should have 3 things. You should have first party, third party, and cyber crime. So those are kind of the pillars of cyber insurance. And we don't expect everybody to be able to get into the nuance of what those pillars are. That's where we come in. But if you just see third party coverage and you don't see things like business income or crime coverage, and you got a $900 premium, that's a pretty good red flag that maybe buyer beware that you have something, but it's not what you should.
Well, and that's actually what I was going to ask you my next question. So we're skipping ahead to our final question, but that's okay because we can rotate. What are the 5 parts of the policy actually paying attention to in terms of, because you get into the policy, sure, big tagline top, you've got a 2 million aggregate, but then scroll down and I start seeing, hey, here's some sublimits of what is covered, and here's some asterisks around the coverage. What are the top 3 things that you should be looking for when you're reviewing a policy? Say, hey, this is legit, or oh, this is a red flag.
Yep. So the three big buckets are first party, third party, and crime. So let's actually start with third party first. Third party is fines and penalties. It's the other guy. If you are in a highly regulated industry, if you're going to have notification cost, you better have that third party coverage, right? So third party's first. First party is your actual material loss to your business. And that, man, this is the one where it gets a little wonky, right? Because there are some caveats in there like dependent business interruption. I'm not going to get on my soapbox about dependent business interruption, but that's a very, very specific key coverage that you need in 2026, right? So when we're looking at material loss to the entity, business income, reputational harm, things like that, there are some caveats in there that you want in there. And then a kind of secondary carve out of that first party, but it is the own thing, is cybercrime. And when we go back to that AI change and we talk about social engineering, funds transfer fraud, invoice manipulation, that's cybercrime, right? So third party, first party crime, right? And then really need to kind of button in with the specialist on what am I doing? What's my exposure? And how does this first party crime thing shake out based on what?
Well, and you're tying, this is all related because my last question for you, and let's dive into this, is what do business owners and executives often assume is just covered, where you've seen the most erroneous things, but you actually need to check the fine details? You just touched on that. Let's expound on that, right? Like, hey, I don't see claim denials in the market from my perspective.
Nope.
What I see is supplementations, the policy was scoped incorrectly, or, there's a dispute, right? There's a gray area that sometimes the carrier and you need to work out a private settlement on because there's no clear rules of the road and it could go either way if we went to court. Like, those are the three areas I see where things get sticky. From you, right? What is the most frequent areas you're seeing business owners saying, I'm just covered, and maybe not?
Yeah. The biggest thing is around loss quantification and the limits that are placed right now. I'll give an example. Like, we'll use a specific example of crime. I had a buddy, he was not a customer, but he was a friend, that had a material loss around invoice manipulation. And I've got cyber, I'm good. So he goes to his agent, he submits a claim. It was a $65,000 invoice. He gets paid $5,000. Right. He's like, my insurance denied me. He was like, no, it did not deny you. It did exactly what it said it was going to do.
It's a contract. It's a contract. The contract says that we'll pay this much if this happens, and we paid this much when this happens.
So I'm like you. I don't see denials, right? CFC at the end of 2024 came out and say, hey, we paid 98% of claims this year. And it was like, oh my Lord, like that's counterintuitive.
Still kind of, I want to talk about that 2% on a different call. That's still the amount of money we're talking about. That's still significant, but it's not like half of all claims or something like that are being done. It's not what I'm seeing at all.
Right. That is counterintuitive to the narrative that's out there about cyber insurance just screwing everybody. It's not denials that'll get you. It is not knowing what coverage is there, not quantifying your risk, particularly around business interruption and particularly around crime. Those are the two biggies where people don't go in and quantify that out. I mean, guys, if you're running 30, 40, 50 million of revenue, and you've only got $1 million of business interruption, and you go down for 15, 20, 30 days, you just ate through your entire limit of cyber insurance on business interruption. And we haven't done incident response and forensics and legal and all that other stuff. So that's really the issue that we're seeing is insurance is here. We didn't really quantify loss. We didn't understand it. Loss is here. And I get something, but I don't get all of it back. The NetD report said that on average, people make about 60% of their claim back.
Yeah, I mean, so what I see on my side of things is not claim denial, because there's a vested, and for those of you who are a little cynical, because Andy, you are an insurance person, so the dealer pushing his product.
I do come with bias.
What I see in a non-biased area, because I do not work for the insurance space, I do not do coverage, I do not make commissions on insurance. I am not an agent. But what I see is more often than not, the areas that are stickiness end up in private settlement because it is an area the contract is not properly quantified, right? Like, it is vague, and there's area, like, both the carrier doesn't want to go into the claim denial. Like, they have a business to run, and if everyone knows that they're denying claims left and right, who's going to work with them, right? Like, that is, you got to understand, there is a real financial greedy reason they don't want to do that. Now, what I do see, however, is when there's gray areas, you tend to end up in private settlement. You tend to end up, negotiating out a deal that maybe isn't the full policy, but there's a fraction because the risk wasn't properly quantified and there's vagaries and nobody wants to go to court, right? Like, that's what I see. And people, that if you're not used to doing that kind of world, that can put a very bad taste, especially when there's an NDA attached to that and you have to kind of squawk and go, but that's part of contract law. Sorry guys, like if people misunderstand insurance, it's just a contract between you. I pay you a certain amount of money, you cover a certain amount of risk, and here's the limits of what you cover in exchange per year as long as I pay you that money. Like it's not in the contract.
Yeah, no, you're right. Yeah. And what it comes down to on our end is, when you fill out that application, that's an official attestation about what you're doing on your network. We've talked about this before. There's gross misattestation and there's accidental or minor misattestation. Do you have MFA? Yes or no? Yeah, we've got it. Where do you have it? We've got it everywhere. And then there's a loss and you show up, forensic shows up and there's no MFA anywhere. That's a gross misattestation, right? Do you have MFA? Yes. Where do you have it? We have it everywhere. You onboard a new employee. That person doesn't have MFA. There's one little, you're still going to be covered, right? Yeah,
they're not going to run that kind of PR nightmare. It just
yes. So there, it really, what it comes down to is that attestation, that application. Be as true. You mentioned this, and I thought it was a great point. Be as truthful as you can, right? Fill it out as best as possible. Don't sit there and just overly lie on your app to get a better rate and state that you're in this wonderful cybersecurity posture when in all reality, the door's wide open, right? That's what'll get you into the denial realm.
Okay. Well, we're over time here, so we're going to wrap things up, Andy, because we promised the audience a half hour. I know we started a little late. One more time for those who joined later, can you introduce yourself one more time and who you are and what you do?
Yeah, for sure. So Andy Runyan, I'm our head of cybersecurity risk services at UKON, and I spend my days working with folks like Logan, MSPs, MSSPs across the country, help them understand their risk, help their clients understand their risk. We as an entity are a cyber insurance and tech E&O wholesaler. We specialize in nothing but cyber insurance. So we work with businesses all across the country in all sectors and walks of life to help them quantify their risk and place solid cyber insurance.
And I've just posted a link in all three of our live streams. If you guys want to talk with Andy and work direct to figure out if your cyber insurance is where it needs to be, or if you need to get cyber insurance, we worked with UKON now for a few years, and we've had a great experience with you guys. And so that's one of the reasons why whenever I do these interviews, I'm like, hey, I want to talk about Andy because this is changing year to year. And I really am kind of interested to see how the AI conversation plays out. Like you said, it's a couple years behind, but we're not that far from them having to have those conversations. So 27, it sounds like 27 is the year you think those are going to start to materialize in the market from your perspective.
Yeah, and we're seeing the early days now. I mean, Coalition 2 weeks ago just came out with the first agentic AI endorsement for MSPs on their professional liability form, right? Like that's a first in the industry, and it just happened. So like we are literally sitting in the driver's seat as the car is going down the road to a destination not quite known right now.
Okay, well, we're going to have to get you back on in a year's time to go ahead and chat about that. My name is Logan Edmonds. I'm CEO of TTS Cyber. If you are wanting to know cool tidbits like this and you don't have 30 minutes to sit down for a webinar, check out our newsletter, Artificially Informed. We are doing interviews. We are doing the latest stories and greatest in the fields of AI, technology, government, security, and everyday life. Once a week, 7-minute read to stay up to date on what's going on so you can make informed decisions. Thank you for your time, Andy. Appreciate you as always.
Always love it. Thanks for having me on.
See you on the next one, guys.